Hi, I'm Luke Lango, and this is Investor Place Quick Picks, where we communicate to you some of the market's best investment ideas in just 10 minutes.
America's #1 stock picker, Luke Lango's Investor Place Quick Picks.
Today, we're going to interrupt our regular cadence of stock picks to talk about the macro factors that are driving wild gyrations in the stock market. Specifically, we are going to talk about inflation. Now, I'm sure you've noticed recently it's tough to miss tech stocks have fallen off a cliff over the past few weeks as treasury yields have risen. But why? What does that actually mean? And more importantly, are these fears of rising treasury yields legit, or are they overblown? Let's take a deeper look. So first, let's understand the connection between treasury yields and the stock market. And it really all comes down to this. Stocks and bonds are competing investment vehicles. That is, your money can go to work in either stocks or bonds. The difference, of course, is risk and reward. For the most part, bonds are less risky but offer less return. Stocks, on the other hand, are riskier but offer more return. Thus, when investing in a stock, you're going to require an additional expected rate of return over a bond's expected rate of return to account for the fact that you're taking on additional risk. In finance, this additional rate of return is called the equity risk premium. So, the expected rate of return you require for a stock is equal to the required rate of return you have on a bond plus the equity risk premium. Formulaically, this is represented by the capital asset pricing model, or CAPM for short. Now, the capital asset pricing model states that the cost of equity, which is finance lingo for the required rate of return on a stock, is equal to the risk-free return rate plus the equity risk premium. Okay, so here is where the 10-year treasury yield steps in. Now, treasury notes are considered as risk-free as it gets. They're basically bonds backed by the US government. So, as a proxy for the risk-free rate, investors and analysts often use the 10-year treasury yield. Therefore, the cost of equity equals the 10-year treasury yield plus the equity risk premium. Now, the 10-year treasury yield is rising sharply right now. That means the right-hand side of the equation is rising sharply. By the law of mathematics, then, that means the left-hand side has to rise just as sharply. So, as the 10-year treasury yield has climbed 50 basis points over the past month, the cost of equity has theoretically also risen 50 basis points. And as the cost of equity moves higher, the present value of stocks moves lower. That's because the present value of a company is equal to its future cash flows discounted back by the cost of equity. So as the cost of equity moves higher, the lower the present value of those cash flows goes. So, all in all, in a nutshell, basically, that's the math behind this whole phenomenon. In short, the higher the 10-year treasury yield goes, the higher the cost of equity goes, and the less a company's future cash flows are worth today. Of course, this dynamic has a more severe impact on growth stocks than value stocks. That's because value stocks have less value riding on future cash flows than do growth stocks, and therefore their present valuations are mathematically less impacted by these dynamics. This is why hyper-growth stocks are plunging right now. I mean, the NASDAQ is down big, while value stocks are weathering the storm pretty well. The Dow is actually making new highs every single day. Now we get to the more important question at hand. Are these fears, these inflation fears and surging yields, are they legit or are they overblown? I mean, ostensibly, they make a lot of sense, right? Because we have a rebounding economy jolted by a ton of stimulus. But if we take a step back, zoom out, and look at the big picture here, none of this makes any sense. I mean, inflation that's going to run and stay above 2% for years? Really? I'm sorry, that's just not gonna happen. Absolutely 0% chance. Sure, I get the fear. Lots of fiscal and monetary stimulus, lots of pent-up demand in the pipeline. Those two will couple in 2021 and lead to a huge surge in consumer demand for all things. Now, supply for those things will remain relatively muted since supply chains aren't up and running at 100% capacity yet. Big demand, limited supply, that should lead to higher prices. Seems pretty straightforward. But that cursory analysis actually misses the most important factor in the inflation equation, and that's technology. You see, technology broadly makes everything more cost and time efficient. Amazon, eBay, Wayfair, Etsy, Chewy. These companies have all made shopping cheaper and faster. Netflix, Activision, Roku. They've made entertainment cheaper and faster. Facebook, Pinterest, Twitter, Snapchat. They've made communication cheaper and faster. Zoom, DocuSign, Adobe. They've made working cheaper and faster. You get the point. These technology companies are making every process in the world cheaper and faster. That's the power of technology. And in so doing, these technology titans have created a deflationary tsunami, which is increasingly keeping prices low across all industries, as all industries adopt tech solutions, oftentimes in place of physical labor itself. Now, many of you might be sitting at home and not believing me here, and that's fine. Let's just believe the numbers, because numbers don't lie. The first website was published publicly on the World Wide Web in August of 1991. That's basically when the public use internet was born, so to speak, and when the internet started to take over the world. Now, to pivotal moments, let's focus on that. Before that time, before 1991, the US was averaging core PCE growth north of 3%, consistently north of 3%. Inflation was hot. But since 1995, core PCE growth has never sustainably stayed above 2.5%. Even further, since 2010, the US has not sustainably held even 2% core PCE growth. Now, this is no coincidence. One thing has been consistent over the past 30 years, and that's the increasing influence of cost and time-efficient technology across all industries. This increasing influence has kept inflation muted for 3 decades through high interest rates, through low interest rates, through economic booms, through economic busts, through stock market booms, through stock market crashes. Through it all, inflation has been muted because of technology. Now, here's the most important part. Technology's deflationary impact on the US economy is only going to accelerate for the foreseeable future. And that's because of 2 things. One, technology is more widespread today than ever before, with every company in every industry of every shape, size, and form utilizing technology in some way or another. And 2, technology is also more potent and deflationary today than ever before. And that's thanks to new AI and automated technologies, which are now capable of fully replacing huge swaths of the labor market. So, with all that considered, when I see the market freaking out about inflation, really, I almost laugh. Like, these fears are significantly short-sighted. Any inflation we do see here in Q2, and yes, I do think we're gonna see a lot of inflation due to base effects, but all that inflation will be transitory. Just as the Fed has said, I agree with them, it will be entirely transitory. Indeed, if you want to look out long-term big picture, we're due for a lifetime of generally muted inflation because we're due for a lifetime of technology taking over the world. And that simultaneously means we're due for a lifetime of big gains in hyper-growth technology stocks. So really, all of that is just a long-winded way of me saying that I have the utmost confidence to buy tomorrow's biggest winners on today's biggest dips. The fundamentals remain healthy. The potential upside is now just bigger than ever before. Well, that's all we have for this edition of Investor Place Quick Picks. I hope you liked what you saw. If you did, please subscribe, hit that notification bell, smash the like button, or if you like to read, come over and visit us at investorplace.com, where we have some of the market's best analysis. Until next time, cheers and happy investing to all.